Ladies and gentlemen, good day and welcome to RPG Life Science Limited Quarter 4 FY2024 earning conference call hosted by Systematic Institutional Equities. As a reminder, all participant line will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vishal Manchanda from Systematic Institutional Equities. Thank you, and over to you, sir.
Thank you, Ria, and good afternoon, everyone. This is Vishal Manchanda, and on behalf of Systematic Institutional Equities, I welcome you to the Q4 FY24 earnings call of RPG Life Sciences. We thank the RPG management for giving us an opportunity to host the call. Today we have with us the senior management of the company represented by Mr. Yugal Sikri, Managing Director, Mr. Vishal Shah, Chief Financial Officer. I'll now hand over the call to the company management for the opening remarks. Over to you, sir.
Good afternoon. Thank you, Vishal. My good afternoon to everyone. I hope I'm audible. As always, it's my pleasure to share with you briefly RPGL's performance versus the market and brief highlights of our performance in Q4, full year FY24, and since we strongly believe that hallmark and true test of a strategy is consistency, and since FY24 marks the 5th year of our transformation agenda, a quick panoramic view of the 5 years at a glance. Therefore, first, the market. In the context of market, as per the database IQVIA Net March, market is currently growing at sub 10%, 7.6%. The LCD works indicate the growth is ahead of 6% or less than 7%. But what is important for me to share with you is RPGLS or RPG Life Sciences is growing at 18.8%, that is 2.5 times the market growth. In terms of volume, market growth is flat. 0.7% is what IQVIA data indicates for market, whereas RPG Life Sciences volume growth is solid 13%. I'm also pleased to share with you that RPG Life Sciences on MAT March 24 basis has emerged as the 7th fastest growing company of pharma industry's top 75 companies. Further important for me to share with you is in Q4, our in-market growth as reflected by IQVIA is 19% versus the industry growth of 5.7%, that is 3.3 times the market growth. Now, let me move to the key highlights of Q4. Q4 revenue growth is 7.2%. It appears slightly muted due to a couple of transient factors which have something to do with a couple of products and a couple of markets. One of our product got impacted because of seasonality. Second one, because of one product discontinuation which happened in the fourth quarter of the last year due to the government order. The third one is with respect to market, where government has imposed some kind of restrictions on the release of import licenses due to the foreign exchange crunch in the country. And I strongly believe that all of these factors are transient and are easily resolvable. Therefore, what is important for us to note is that the in-market growth has been robust 19% vis-a-vis the 5.7% market growth in quarter 4, which I mentioned earlier. Coming to the other financial metrics, I'm happy to share with you they continue to be as robust as they are on full year basis. The growth for EBITDA, PBT, and PAT has been solid 26, 29, and 28% respectively on year-on-YOY basis. Margin improvement also continues with the 5-year Q4 uptrend with a significant increase in the margins in Q4 indices. EPS grew at 30%. With this, I'd like to move on quickly to the picture on full year FY24, and I'm sure you had the opportunity to look at the investor presentation which we uploaded in our website. But if not, just presenting you a few highlights. The sales growth is 14%, EBITDA growth 26%, PBT growth 28%, PAT growth 28%. Vis-a-vis the market, as mentioned earlier, market evolution index is 110. Our growth 18.8%, which is 2.5x of the market growth. Seventh fastest growing company, as I mentioned earlier. Please also to share with you, market rank has been up by 5 positions or 5 notches. And I'm sure you all know our market cap is up by 118%, significantly ahead of the BSE Healthcare Index growth. Our on the margin front, the EBITDA margin moved from 21% to 23.3%, PBT 17.9 to 20.2%, PAT 13.2 to 15.1%, all of them reflecting a very healthy growth in the year FY24. Cash flow, 127 crore after paying record 51 crore capex, which we incurred on the plant modernization, and significantly higher statutory payments. Working capital management continued to be healthy. New product contribution reached closer to 30% of the sales. Productivity uptrend continued. The productivity moved from 5.4 lakh to 5.8 lakh per person. Brand building exercise continued to happen, which resulted in the newer milestones of our iconic or textbook brand. They happen also to be age-old products. Naproxen, which we are aspiring to take it to 100 crore, made another milestone. It touched close to 74 crore turnover in FY24. And as I mentioned earlier, yet another portfolio which we are aspiring to take it to 100%, again, which happens to be an age-old portfolio, is crossed around 70 crore. So both of them are quickly closing to the 100 crore aspirational target which we have set for these products. The legacy products put together contributed 67% to the sales of the domestic business with 15% growth. New product launches continue to be in the segments which we had identified, as well as the line extensions which we have identified in our 3-year new product grid. We did 2 line extension launches for our iconic brand Naproxen, 2 line extension launches for Tycan tablet, and we launched new molecules in our nephro segment. We also launched 2 molecules in the rheuma segment, and I think that continued to augment our portfolio significantly. In the segmental performance, I think the domestic formulation, as I mentioned earlier, continued to register robust growth, which is 15%, and the margins of domestic formulation business touched another record high, easily crossing 20%. International formulation also grew at 15%, and here again the margins, and when I'm referring to RAP margin, I'm referring to the EBITDA margin, it also moved up to its own high so far achieved in the last 5 years. Similarly, API also registered a significant improvement in the EBITDA margin, and but grew at 7%. Now, the API growth is 7% is perhaps understandable because we have not been able to launch any new molecules since we started focusing on API as the third engine of growth. Recently, after we thought our plant upgradation takes place and we are able to invite the regulators to visit the plant, now we have the strategy in place, we have the new product in place, we have the R&D setup in place, and I'm sure going forward, API growth will also be a similar double-digit growth, what we have been mentioning earlier. So on all the three segments, the revenues were double-digit in case of domestic formulations and international formulations, and in case of API, it was 7%. The EBITDA growth in all the segments have been healthy double-digit, and that's what gives us the confidence for going forward. I'm sure you have seen the presentation, investor presentation. I've given highlights about the 5 pillars or 5 growth drivers of domestic formulation business, which are product portfolio rejuvenation, strategic asset building, customer coverage enhancement, productivity enhancement, and cost optimization. Significant strides have been made in each of these 5 pillars, which is what has resulted in the growth which you have seen. Similarly, both on the COGS front and the OPEX front, all the initiatives continue to be as robust as they could be, and all the 6 or 7 initiatives which we have on margin improvement continue to result the improvement in the margins as I described to you earlier. Similarly, coming to IS and API, we have 2 growth drivers, two basic prerequisites. Considerable progress has been made. One was the plant modernization and capacity expansion. I'm happy to share with you both the projects have made extremely significant progress. The API almost complete, and we are expecting the results of the regulators visit, and similarly in case of the formulation Ankleshwar plant, again it is WIP, and we expect that by the end of the third quarter we have invited the regulator, and the regulator visit the plant, and then we will have that facility also ready for the export. So plant modernization over simultaneously, we had also beefed up the R&D. We had created the bench strength for the chemists and the research scientists. We have identified the products both for API and the formulations which are currently under development. As I mentioned earlier, our portfolio strategy is a niche strategy so that we are able to have good margins and good business because it does not attract the attention of the big players. So that's about the 3 business segments. I just mentioned to you about this happens to be the 5th year of our transformation agenda, and therefore I'm very proud to share with you that if you look at the financial indices, almost all the financial indices are at their benchmark if we compare ourselves to companies in the 1,000 crore turnover category. Revenues up significantly year after year ahead of market. We touched 583 crore. EBITDA, we last year crossed 100 crore. This year we touched 135 crore. From 34.4 and 35.4 crore in 5 years has been a significant achievement. Similarly, PBT from 15 crore 5 years back, it is 117 crore now, a multiple jump. Similarly, PAT, which was 10.8 to 87.7, is a very significant jump, almost close to 8 times what we can see in the last 5 years. In terms of margins also, we have EBITDA margin which was 10%, so it's now 23% plus. PBT, which was 4.6%, now it is 20% up. PAT, which was 3.3, is now 15.1% up. And the EPS, which was 6.5 rupees, is now 53 rupees. What is critical and what is important is that not even a single year in the last 5 years, in any of the financial metrics, there has been a blip. It has been a consistent upward trajectory year after year. Similar story was in case of margin, which I mentioned to you already. Now, that's about the 5-year trajectory. Going forward, you would have noticed in our website, we have in the investor presentation, we indicated there are 7 pillars of growth. The first pillar of growth is to have state-of-art plants. Second is the targeted R&D pipeline. I think these two will take care of the business of the 3 segments, all of them together. We have identified 70 products for 3-year product grid, and we are on course to launch the products in the domestic formulation business, international formulation business. Also, we have close to about 10 products. In case of new API, we are close to about 10 products. They are all under development, and therefore that all are going on at the moment. In case of the plant, as I mentioned to you, we are in the modernization quite at advanced stages, and we expect the developed markets regulators to come for approval during this year. In case of the API, the visit has already happened. We expect the revert quickly from them. The third pillar is the innovation. Innovation is not a buzzword. It's actually a necessity for us being an old company. We have done institutionalization of the innovation, and which means every single HOD in out of 70 HODs have a targeted innovation agenda. We are working on technology, digitalization, front end to back end, and I'm also happy to share with you that Gen AI has also found a significant traction in our front end operations. We have completed 13 initiatives last year, and a 3-year roadmap. We have 9 projects being implemented now. Since we have cash on our books, we have a very targeted M&A agenda going on. Quite a diligent work is going on, and this space is little more cluttered. As many people want to grow through M&As, we are also into the race, but we will do something which is value accretive. But on this agenda, we are active. We also identified certain other area of growth, like can we have other than medicines, the medtechs to get the synergy from the doctors whom we have a strong leadership. That work also is going on. And last but not the least is the capability building and talent development, particularly in the area of sales and marketing, digital, quality manufacturing. So that's in a nutshell. I wanted to give you background, and before I start the questions. So thank you so much for your patient listening, and I'm all ears to your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sudarshan Padmanabhan from JMPMS. Please go ahead.
Yeah, thanks a lot for taking my question, and congrats on not only this quarter but consistently performing, for the last 3 to 4 years. I think it's been quite transformational, to say the least. So my question is, we have also been investing quite a bit in the chronic business. While I'm happy to see, certain brands reaching a scale, if you can talk a little bit more about the aspiration of one, having more than 50 crores and 100 crores brand as you touch the 1,000 crore mark, aspirational mark? And second is the proportion of chronic, as a percentage of what you expect from the overall domestic business. The second question is on the margin. I think, as you said, from FY20, FY19, you've seen consistently, margins across all heads, improving, cost improving. Given that we have some, kind of a near-term, war-like situation and issues in the sense the Red Sea, etc., how do we see the margin in the near term? And also from a longer term, as you touch the 1,000 crores, where do you see the EBITDA margin? These are the two things for mine. Yeah.
Okay. Thank you for the question, and I think both are very important questions. As I mentioned to you earlier, that product portfolio rejuvenation in domestic business is targeted towards two specific action agendas. One is, since we have very strong, what we call it textbook or iconic brands, how do we convert those brands where we see promise into mega brands? So that's one. Second is, as rightly pointed out, chronic. How do we maximize or enter even the chronic part of the business? Traditionally, historically, we have not been strong in chronic. So there's chronic as well as specialty. So first, as I mentioned, is the textbook iconic brands maximization through a very diligent life cycle management strategy, and the second is entering the chronic and specialty businesses. The chronic area which you identified, new therapy area, the rheumatology, dermatology, gastroenterology, and on the mass side, urology and cardiovascular metabolic disorders segment. So now the actions have happened. One action is, do we have the targeted doctor? We didn't have target doctors in our customer list. We have made sure that almost 90% of this particular segment doctors are covered. So we have put that in place, number one. Number two, we should have products. So we have identified the products. We have a 70 product grid created in which quite a number of products are, other than the line extensions for the iconic brands, which comes under life cycle management, quite a number of products have been identified in the chronic and the specialty segments. So that's the second part. The third part is the field force training. We have worked on the field force training so that they are equipped to launch such products in their respective segments. So these are the actions which we have taken. So on the as far as the 100 crore or 50 crore aspiration which you talked about, the aspiration we did it for the Naprosyn as one brand, as I mentioned, which was 18 crore in 5 years back, is now almost 74 crore this year, and we think in a couple of years we should be able to touch 100 crore. So aspirationally, that's one brand we should be 100 crore. And second is the portfolio, which is immunosuppressant portfolio. We are very strong in one molecule called azathioprine. Now we are focused on the 4 molecules in that segment. Apart from azathioprine, the other 3 are mycophenolate, tacrolimus, and cyclosporine. Put together, we are wanting that portfolio to also cross 100 crore. So that's on the textbook product or the legacy products. Now, in terms of the chronic, we have products launched in number of the sub-therapy segments in cardiovascular and metabolic disorders, which includes anti-diabetic products, which include gliptins, which include gliflozins, and their combinations. We are launched some products. We are in the process of launching of the product. We are mindful of the fact that we are a late entrant in this market. Therefore, it would take time for us to establish ourselves and take away the share from the existing players who are hugely invested in that field. We're mindful of that, and we are also okay for a hockey stick kind of a growth, and that we are committed, and we think that chronic will also be able to give us the business, because it's important for us to be in the chronic business. That's long-term, that's also more profitable, and that's where all the new products new molecules which are identified are largely belonging to chronic and the specialty segment. Now, specialty segment, nephro, we are strong, so we are continuing to launch new products in nephro. For example, this year we launched ferric carboxymaltose, FCIRO as a brand which we launched, and Ruma, which we entered as a life cycle management strategy for immunosuppressant. We have launched Ruma is a product. This year we launched teriparatide as one of the products, and iglotinib is another molecule which we will launch in the Ruma basket. Similarly, the gastro and derma are in incubation. We are covering almost 50% of the targeted doctors already there. That's also part of the life cycle management for immunosuppressant. As we get established in that segment through our immunosuppressant basket, then we launch derma-specific and the gastro-specific products. That's where we are. This is where our status is on the two segments of growth driver, if I put it that way. One is the existing product life cycle management, and second is the maximization or entry into the chronic and specialty segment. Now, the second question was with respect to margin. The margin, you would have seen the margin uptrend trajectory in RPG Life Sciences has been very indicative of the fact that what is leading to margin improvement. As I've been saying every time, our margin improvement story is structural, which means we are addressing the basic elements, basic cost elements, whether they come in the COGS or OPEX, and doing some fundamental changes there, which is why the margin improvements are happening year after year after year. And I understand there are issues which are relevant to us also, whether it is the Red Sea or Middle East conflict. They're impacting us as well. But I think since our structural agenda is so strong, it is not only able to overcome the negatives of coming out of those external factors, but also is able to improve our margin. That's why you will see the gross margins improving, and so also the EBITDA, PBT, and PBT are improving. I hope I've been able to answer your question.
Sure, sir. So we should basically see an improvement in the near term as well. I mean, apart from the long-term operating leverage that will play in terms of the margin.
Yes. The only rider I'll add there is that if you see the slope of our margin improvement is quite steep in the last 5 years. Going forward, that slope is going to be not as steep. It's going to be a little obtuse. That's the only point I need to put across.
Sure, sir. And one final question before I join the queue is, one is, on an absolute cost basis also we've seen a significant improvement. So, I mean, how much more is left, apart from the structural changes that you talked about? And what interestingly, has been happening is we have basically seen a phenomenal, utilization of our field force in terms of launching products, in terms of line extension. So can you talk a little bit more about your field force? Has the field force, already been created for the chronic? So which means that every unit of sales, you will have an operating leverage on margin. I'm talking about more from a structural and a longer term basis in this side.
Yeah. So, in pharma, very important is the prescriptions. And second important is your relationship or the engagement you have been able to do with the customer. Now, you know well that chronic part, for example, is something which is already well entrenched by very age-old players, whether it happens to be Sun or USV or Sanofi. They're all very well entrenched in the cardiovascular area. What we have done at our end is we have identified products, as I mentioned to earlier, which we are launching in a very professional way, and we are training our field force. Another important thing I should mention at this juncture is that we made use of digital in a very, very interesting and productive manner. We have launched an initiative called RPG Serve. The name itself is RPG Serve. We have onboarded close to about 90,000 doctors in this portal, RPG Serve. And this portal is providing the close to about 34, 35 services to the doctor. And what is important is that we keep on changing those services so that there is a newness factor. And that is working out a very good tool for us to increase the share of voice. Otherwise, in physically, maximum time a rep can meet the doctor is maybe 24 times a year. But in this case, we are able to reach the doctor through this portal n number of times, 10, 15, 20, 30 in a month, depending upon the services which the doctor asks us. So these are the areas, these are the things which we are working on, which have given us dividend in the entire legacy portfolio of ours. Therefore, I said growing at 15%. But I'm sure it will also help us to establish in the new segment which we entered called chronic, and that is particularly CVM. Having said, there's some traction I see in the our Euro business is growing at 20% or so. Though it's small business, contribute only 3% to our business, but it's growing strong. Roma business, which we entered just about 3.5 years back, is also doing pretty well, contribute close to about 5% to our sales at the moment. And I'm sure similarly, Derma and Gastro will also contribute, as I elaborated earlier.
Sure, sir. Thanks a lot for your elaborate answer. I'll join back to you.
Okay.
Thank you. Next question is from the line of Sejal Kapoor, an individual investor. Please go ahead.
Yeah, hi. Thanks for taking the questions. Good afternoon, Mr. Sikri. I have two questions. What's our net cash position currently, and what organic, inorganic plans we have, given the trend that is emerging on the acquisition side in the Indian market? I've seen companies acquiring assets at 7 times, 8 times sales. I mean, is that something that we would be prepared to go for, or what's the overall plan? Because the cash will continue to increase year over year or quarter over quarter, actually.
Yeah. Thank you so much, Ms. Kapoor, for a very relevant cash question. As you have yourself rightly pointed out, because the operating performance is improving, margins are improving, therefore profit volume is improving, and despite the fact that we have invested this cash which we are generating for our future growth by investing in the 2 plants which we have, API plant and the formulation plant, which needed modernization, so that we can use both the plants for exports. We had only 10% contributing plant in the formulation which was being used for exports. Now we have the entire 100% plant refurbished and waiting for a regulatory approval to happen, and that would be used for the expanding the export business. And similar thing for API. Now, what we did was, since in our business, 67% comes from the domestic formulation and 18% comes from the international formulation, 15% comes from the API. Obviously, our priority was the domestic formulation, and we actually worked on domestic formulation, and I've described 5 pillars already. Now was the time for international formulation API, and the prerequisite was that we must have modern plants. I'm very happy to share with you the both plants are modernized. The plant, which was 55-year-old plant, now you can see it is totally refurbished, ready for approval. I dare say even US FDA readiness has also been considered when we have created a new plant for API, and similar thing is formulation. So that will help us for the organic growth to make the international formulation API as the second and third engines of growth. So that's on the organic part. In the DS, it is more OPEX driven because we have to expand the field force. We have to launch new products. We have got very, very good CDMOs in the country, and I think we use them to get new product supplies fast, and we are launching those new products. So that's the organic part. Inorganic part, as you very rightly mentioned, since we have close to about 127 crore in our books now, and after investing, as I mentioned, huge amount of capex, close to about 140 crore in the last 3-4 years on the plant modernization, including our office modernization, I should say that. Now we are looking at the acquisitions, and you rightly mentioned the market is crazy. There are crazy valuations, and we are also. I can only tell you that we have created our framework. What kind of molecules, what kind of therapies, what kind of these products which we are going to acquire, which are likely to acquire, should have. All that diligence is going on. We have actually, just to share with you, around 23 proposals reviewed in the last 1.5, 2 years. And we also submitted non-binding bid. But the market is a bit crazy. We don't want to do any acquisition unless it makes sense, value accretive. But we are hopeful. We have also added into our M&A list APIs as well. Earlier we were looking only in formulation, including APIs, because I think that space is also presenting very good opportunities. So that's where our net cash is being planned to be utilized. I hope I could answer your question, Mr. Kapoor.
Yes, Mr. Sikri, and as a follow-on question, so the market, the Indian pharmaceutical market is highly fragmented, right? So if we exclude the top 15, 20, maybe let's say top 50 players, there are hundreds of small, micro, nano-size companies. How does that landscape look like in the ecosystem or the emerging ecosystem of, this government and generic rollout, the Jan Aushadhi? And so currently, I understand that the back end of EU, not EU GMP, the WHO GMP infrastructure. So there are close to 10,000 CMOs in India, and most of them, more than 90%, I believe, are not WHO GMP compliant. So there is a guidance, but not the law. So let's say over the hypothetical scenario, of course, let's say over the next 2 to 3 years, majority of these CMOs either they disappear and they go down under, or they upgrade to become WHO GMP compliant, and then the government will be in a better position to roll out the generic push. So in that context, assuming that scenario plays out, how will branded generic space perform, and what does that mean for a company like RPG Life Sciences? In that kind of a scenario where we have real push coming on the Jan Aushadhi or generic rollout?
Yeah, I think it's a very pertinent question, Ms. Kapoor. Yes, looking at the way our market characteristics are, it is a very highly fragmented market. We have many players. Generic is getting a push from the government. There are Jan Aushadhi Kendras coming up. The government is also issuing directives to the government doctors to prescribe generic. And you rightly described, there are large number of CMOs, CDMOs, and then the GMP is an issue. I think you have laid out the landscape pretty well. I have some observations and some thoughts. Of course, as the things play out on the sea, ours is a branded generic market. Almost 90 to 93% is the branded generics. Were generic not there earlier? Generics have been there earlier for decades now. Were Jan Aushadhi Kendra not there earlier? I think somewhere in the early 2000s, the Jan Aushadhi Kendra were launched by the earlier government. Are they under emphasis by the government? Yes. How many they have launched? They have launched somewhere around some 6,000-7,000. They plan to take it 10,000 or 20,000. And those 10 or 20,000 which they plan to launch up, even go to 30,000-40,000, they compared to some 700,000, 800,000 pharmacies or chemists we have in the country, they will still be much less in terms of percentage, number one. Number two, the performance of current Jan Aushadhi Kendra is lackluster because they have insisted that they should get the supplies from certain authorized manufacturers, and if you visit them, you'll find paucity of the brand or products available from there, though they are available at 70-80% cheaper compared to branded generics one. And the second one is you would have seen the kind of the news which we get when some children died elsewhere. We see large number of CDMOs CMOs which are not CGMP compliant. We also see the government regulatory infrastructure is not just not sufficient enough to manage and regulate such a burgeoning pharmaceutical manufacturing setup in this country. So yes, is it a threat to branded generics? Yes, in a way it is. But will it impact so strongly going forward in the foreseeable future? Not to the extent that becomes alarming. Now, the current regulators realize this, that quality is critical. It's just not the cost; the quality is also critical, and therefore Schedule M, GMP, etc. is being talked about and being implemented. So, all in all, I think all these points which you mentioned, yes, on the macro environment, they are concerning, but on the ground, will it make an impact in the next 5-10 years? Not to that extent. That's what is my personal assessment or take.
Yeah, no, that's helpful, Mr. Sikri. I think my assessment was in line with yours, but because you are industry veteran, I thought I'll just double check my understanding with yours. You mentioned quality and not just cost. The thing is, if you start upgrading these non-compliant CMOs in the country, the cost of compliance will force their operating expenses to go up, and then in that scenario, they will be forced to price their products higher, right? And so then the economics that will likely play out will look different from what the cost economics that is currently present, because they're not investing in the compliance. The quality is poor. It's not reliable, and therefore the products are cheaper. Is that a fair assessment?
Absolutely, I agree with you. Yes, with this, if the regulators continue to push these reforms, I think it will reset the manufacturing landscape. There are some people who will have to opt out because the quality has a cost. It has a definite cost. And it will reset the manufacturing landscape, I very strongly feel. It all depends upon how strongly government pushes that agenda. Currently, if you look at the government infrastructure or inspection infrastructure, their ratios are extremely pathetic, and they have to beef up their own regulatory infrastructure. And if they do that, I think the reset of the manufacturing landscape will happen, and what you just mentioned is most likely to happen.
That's helpful, Mr. Sikri. So we have been invested in RPG Life Sciences for 10 years now, and thank you for increasing the dividend yet again. Thank you.
A pleasure. Thank you, sir.
Thank you. I'm done. Thank you.
Thank you, Mr.
Thank you. Ladies and gentlemen, due to time constraint, please limit your question to strictly one question per participant. Should have a follow-up question, we request you to rejoin the question queue. Next question is from the line of Himesh K. from JM Financials. Please go ahead.
Yeah, hi, sir. So you have answered my colleague's question, so I'll not take much time. Only one suggestion, sir. The new product launch, sir, we have been, tracking since FY19, and I understand that's a transformation program that we had. But going forward, if you can change it to, last 2-3 years, that will be helpful for us to track how they're doing. So all the best, sir. Great performance, and not morning question. Thanks, bye.
Thanks for the suggestion. I generally have a little long-term perspective because I know in pharma selling and marketing, once you launch the product, people forget the product. And then it comes to you later as expiries. That's a very common thing. Therefore, I include the new products, and as this tracking helps us to see that everything is going in the right way.
Sure. So maybe, 3 years and 5 years, maybe in a bit of bifurcation. As an analyst, we like to see last 2-3 years, how has it been done. So this is a suggestion. Thanks a lot and all the best.
Sure, Dinesh. Sure. Thank you.
Thank you. Next question is from the line of Nimish Mehta from Research Delta Advisors. Please go ahead.
Yeah, thanks for the opportunity and RTS, congratulations on consistent performance. A lot of the questions related to the trade generics have already been answered. Just one thing. Sir, how do you look at, our own capacity management? So, one, are we likely to outsource more or are we likely to outsource less, given that the manufacturing environment, as you rightly pointed out, is becoming stricter by the day? So, if you can just give me a sense of what is our current outsourcing percentage and what do you think is likely to happen when it comes to investing in the capacity?
Okay. Thanks, Dinesh, for that question, very pertinent question. Yeah, as I mentioned earlier, we have modernized our plant. We are in the process of modernizing our plant that I mentioned to you earlier. At the same time, we are also adding to the capacities which are being added are close to about 25 to 30%. If I refer to the two plants, formulation and API. And with respect to the decision to source the product from the third party or from outside or internal, I think it's very, very, our strategy is extremely clear. When it comes to new products in domestic business, I think we have very good CDMOs available in the country. And being in the industry for a long time, I have my personal connection with large CDMOs whom I observe. I know that they have not only a good development lab, development scientists and development plan, but they also have the manufacturing operations with good CGMP being implemented. So our almost entire new product in the domestic business are being outsourced. As far as the existing business is concerned, existing products are concerned, we take a very prudent decision. We see what is gross margin accretive to us. We take a decision on that count, and accordingly we either manufacture the product in-house or we manufacture product outside. Broadly, it's about 30-35% plus is the domestic formulation business which we are outsourcing. And new products I already mentioned to you, almost entire new product we outsource. We also have plans that and I think that's a smart strategy. When the volumes pick up for the new products, we do consider to bring those products in-house because that adds up to a few percentage gross margin for our case. We don't have a risk because the product might fail. We only do it when enough volumes, our threshold volumes are created, and then we bring the product in-house. Overall, broadly speaking, we will like to use our facility for the exports going forward, and more and more outsourcing we'll do. But before we do the outsourcing, our outsourcing partner selection is very, very robust because we are mindful of the fact that GMP is critical, and in our growth journey, we would like our product to be seen as quality products. So I hope it answers your question.
Yeah, pretty much. Just that, so now that we are increasing the number of products, new products, the percentage of outsourced products will also increase, right? So essentially, to that extent, there might be some margin impact as well. Is that a right way to look at it or no?
I should mention that I think margin is also important for us because upward trajectory of margins for the last 5 years has been our aspiration and which drives us. So what we are doing, the products which are the chronic products, specialty products. We focus on 4 products which have good margins, which have relatively a good margin. Should not become margin dilutive for us, at least. So selection of the product takes care of the margin part from the CDMOs. Plus the relationship with the CDMO and the assurance to them that we will source the product from you. So all that broad arrangement also helps us to have a good margin situation even with the CDMOs.
Okay. That helps. Thank you very much, and best of luck once again.
Thank you, Dinesh.
Thank you. Next question is from the line of Ankit Pandya from InCred Asset Management Company. Please go ahead.
Yeah, hi. Thank you. And congratulations on the great set of numbers. So just 1-2 questions. So in the initial comments, you mentioned that, there's been some government has imposed some restrictions for from the point of view of international formulation business. So can you give some more clarity on that part?
Yeah, see, this is largely in emerging market, Ankit. There are countries where the foreign exchange is being conserved by the governments. So their issuing of import licenses is being regulated by the government. Even though the fact is that we have very good customers and the partners there, but that situation is what some hiccups it creates during the year. That's what happened perhaps in last year. That's what I mentioned in that context. Whether that market is market of Myanmar, some such restrictions in Iran, where the governments are wanting to conserve the foreign exchange for their own priority areas. Now, is pharmaceutical a priority area? Yes, priority area, and that's why I'm confident that these are transient, and since we have very good customers, connected customers there, we think we should be able to tide over these hiccups also, because the government cannot put embargo on the medicines for a long time, particularly when they do not have a large manufacturing base of their own.
Okay, fair enough. So another point related to international formulation was given that for the past few quarters we have been seeing strong growth, and Q4 current quarter has been largely flattish for the international formulation. So is there any impact of even the Red Sea, there's been a delay in supply chain issue, anything regarding that?
No, I think just one happened, because as I mentioned, we are having plant modernization going on simultaneously. So for which we had to shut down our plants, one or two blocks, because we were modernizing these was to move to new facility, new block. So there was some supply issue for particularly one product, and that's what I just mentioned. But I think that's all over, because the plant is ready. We have in the new plant, the production has actually started, and we also started getting the deliveries in the quarter 1. So that was the only point. Else, I don't see an issue. Further capacity expansion is also for the capacity expansion. I think we have the capacities available to produce the products. Plus, we have done the expansion now that takes away that fear absolutely from our minds of supply being a constraint.
Okay. So, lastly, just on the API, given that you mentioned that due to about plant modernization and there's been no new launches, and that is been largely completed. So, can we expect this from the second half of FY25 onwards, the growth in API should pick up, given that we'll be launching new molecules and for the API business? And another question on the capex fund. So, last year we have done around 65 crores of capex. So largely believe that it is majority of the capex is done. So how much can we expect going forward for the next 1 to 2 years?
Okay. So, Ankit, you are very knowledgeable about pharma, I know. Therefore, first question on API you mentioned. We have identified API. First of all, we have created in the new state-of-art API R&D. We have hired the scientists. This was all skeletal earlier. We have hired and we have identified new APIs. And the work is now going on. It takes about 1.5 years, for a new molecule to be out in the market. That's the development time, and then you have the regulatory approvals required for those products. So last year we did all of that. We created a new API R&D state of art. We hired the scientists. We identified the molecules. The batch work has started, and they are at various stages of the new product development. So next year, this year, second half, we'll get the products. That would be too ambitious. But I think we should start getting the products from the FY2026 because I see good progress happening. There's very strong reviews happening on all the new products. So I feel that that should start getting reflected properly in FY2026 instead of FY2025 because all these products are under various stages of development. Regarding the capex, I think you asked about the capex. The large part of the capex is done, frankly speaking, and now the capex which will come will be more situational. If we get a very good opportunity and for which we have to create a facility or create a particular manufacturing setup, whether it is something to do with granulation, compression, whatever. And we are prepared to do this, and that might have a capex. Otherwise, we will have the routine capex. We will have the capex which gets included in the new product development, and also the capex which I said could be when we have a opportunity. Now, for example, we were approached by a customer from the developed market, Australia, and they wanted us to develop the product, to have a product which was niche product. So we gave them the niche product. We impressed them. Then they came up and told us that they want to get the product delivered or manufactured by us in a very limited span of time. We created additional facility because we saw that business, a promising business, and we spent capex on that. And finally, I'm happy to share with you that actually the deliveries from the new site, newly created facility has started. So such kind of situations, yes, we will have the capex being spent. So more or less, I think this is how it is. Plus some digitalization agenda, some kind of robotics, etc. When we are improving our manufacturing infrastructure, that would entail some kind of capex.
Okay. So just a clarification, the new capacity that you said for the Australian customer, so this is apart from the Ankleshwar capacity expansion that you have done, this is over and above that you have done capex, or you will be doing capex?
No, it is included. It is now, since the facility is created and the manufacturing started, the leads have started, it is included in the capex which you have spent already.
Okay, all right, okay, fine. That's it from my side, and thank you and best of luck, sir.
Thank you, okay.
Thank you. As there are no further questions, I would now like to hand the conference over to management for closing comments.
Okay, so I must be grateful to everyone who is on the call today and who has asked a number of questions. I can tell you that the results which we have got in the last 5 years, including the last year, are the result of a very clearly established transformation agenda, which is focusing on 6 or 7 tenets, and those 6 or 7 tenets will drive the growth further. That's point number 1. Point number 2 is the growth engine, which used to be domestic formulation alone, would be added by more growth engines, which are international formulations and API, and the works are in full swing in that direction. Number 3 is with solid performance improvement happening and the cash flow being generated, we are also wanting to beef up the progress by inorganic route, and when happens, we can't predict that, but there are very sincere, diligent efforts going on in that direction that should be able to drive the growth. Overall, put together, we want this company to move to 1,000 crore mark. This is the well-conceptualized strategy which we have in place. The kind of the recognitions we have got from the industry are really overwhelming. We had been featured in Dun & Bradstreet top 500 value creators. It's very humbling. A company of our size got placed there. And so all of this, I think, that gives us renewed confidence that we will be able to achieve not only the target of 1,000 crore, but also create brands, solid brands, which will become multi-100 crore brands going forward to get us our due place in the committee of the pharmaceutical industry companies. Thank you so much for coming over and your patient hearing.
Thank you. On behalf of Systematic Institutional Equities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.